The same sandwich your grandparents bought for pocket change now feels pricey. The sandwich stayed simple. What changed is what each dollar can buy. You meet the price at checkout and think it's the same lunch. So why does the tag keep climbing if the sandwich barely changed? Economists call this inflation, a broad rise in prices across the economy. When overall prices rise, each dollar's purchasing power falls, which makes items feel pricier. One driver is demand. More people trying to buy the same stuff pushes prices up. Another is money conditions. More money in circulation can amplify that chase for limited goods. Costs matter too. Ingredients, wages, and especially energy can raise what it takes to make and move food. When inputs jump, sellers often pass some of that along as higher prices. Recently, restaurant meals have tended to get pricier faster than groceries, which adds to the feeling at lunch. Same sandwich idea, different setting and markups. Context matters for how quickly tags change. Energy can move many tags at once. When fuel and power jump, transport and production costs spread through menus and aisles. Recently, energy drove much of a monthly price rise, which is why increases can feel sudden and broad. You'll hear headline inflation and core inflation. Core trims food and energy to spot underlying trends. That split helps explain why your grocery run, and the charts sometimes tell different stories. Lately, overall prices were rising at about 4% year over year, while core was closer to 3%. So the broad climb eased from the recent surge, yet it's still faster than many people expect. Back in mid-2022, inflation hit a 40-year high near 9% year over year. Since then, price growth cooled, but that spike reset many tags higher and stuck in memory. The central bank's longer-run goal is about 2% inflation, measured on PCE rather than CPI. They aim for steady expectations, so purchasing power erodes slowly over time, not in lurches. At roughly 2% a year, a typical price level lands near 50% higher after 20 years. That quiet compounding explains why a familiar sandwich from decades ago feels cheaper than today's, even unchanged. Wages come in two flavors, the number on your paycheck and what it buys. When prices climb faster than pay, real pay falls and lunch bites harder. Lately, average hourly pay, after inflation, slipped a bit compared with last year. Even small drops feel big when essentials like food and energy take larger budget space. Why lag? Many wages reset slowly. Annual reviews, contracts, norms, while some prices move weekly. That timing gap makes inflation feel worse until pay catches up, if it does. Now rewind the same sandwich through 1980, 2000, and today. Recipe steady, tags larger. The sandwich changed less than the money. Purchasing power shrank step by step. Supply matters too. When parts, trucks, or staff are scarce, fewer goods meet strong demand. Shortages raise costs and prices together. When bottlenecks clear, some pressure eases. About money growth. One view links the 2020 to 2021 surge in M2 to later inflation. Others stress demand shocks, supply snarls, and expectations. Policymakers don't target M2 directly. Expectations can move behavior. When people expect higher prices, they buy sooner and seek higher pay. Firms watch the same signals and may adjust tags early, trying to stay ahead of rising costs. Businesses don't update prices daily. They batch changes to limit hassle and confusion. That batching creates stepwise jumps, so the lunch tag can sit still, then leap. Prices reflect costs and markups. In busy times, some firms widen margins, while competition can pinch them back. So the same ingredients carry different tags depending on rivalry, rent, and risk. When one option jumps, people substitute, make lunch at home, switch bread, or skip extras. Those swaps shift category demand, slowing some increases and speeding others. Your inflation rate depends on your basket. Heavy restaurant spending feels different than a pantry first month. Headline numbers average many lives. Your mix can run hotter or cooler for a while. Different forces, demand, cost, supply, expectations, markups converge on one result. Each dollar buys a little less. That's the through line behind rising tags on the same sandwich. The recipe stayed simple while the money quietly shrank. A price isn't one decision. It's a chain: farm, factory, warehouse, truck, store, and sometimes cafe. Each link adds costs and a margin, so small shifts upstream can echo into a bigger tag downstream. At a cafe, you're buying time and labor along with ingredients, cooks, rent, utilities, and cleanup. When those service costs rise, the sandwich feels pricier, even if the recipe barely moves. Policy tries to cool broad inflation by making borrowing costlier and saving slightly more rewarding. That slows big purchases and hiring plans, easing demand so price growth can settle. Falling inflation means prices rise more slowly. That's disinflation. Deflation is prices falling outright. Most frameworks aim for steady, low inflation because outright drops can freeze spending and jobs. One item jumping isn't inflation by itself. It's a relative price change. Inflation is the broad rise across many goods and services, which is why baskets matter. You'll often see CPI in headlines, while the 2% goal is defined on PCE. They differ in coverage and weights. PCE adjusts more with spending shifts and includes purchases made on your behalf. Our brains track dollars, not purchasing power, which is why raises can feel bigger than they are. Looking in real terms fixes the illusion. What matters is what your pay can actually buy. Prices are signals, not just bills. Moving tags reroute effort, ingredients, and investment toward what's scarce. A small, steady rise keeps signals alive without forcing chaotic jumps that scramble planning. Single months are noisy. Holidays, storms, and sales can bump prices temporarily. Trends show up over longer windows, which is why year-over-year views are common. When essentials take a bigger slice of your budget, every other purchase feels tighter. That squeeze can persist even as inflation slows, if pay or rent timing doesn't line up. One clean comparison across decades is time. Minutes of typical work per sandwich. Convert prices into time, and you're measuring purchasing power without the dollar's shifting yardstick. So the sandwich didn't get fancy. The measuring stick changed length. Year to year, expectations, costs, and demand nudge that yardstick, and purchasing power adjusts. When inflation slows, the price level stays near its new baseline. Slower growth isn't a rewind. Many tags reset higher, then change gradually as costs and competition evolve. Stable expectations around low inflation make planning easier for contracts, wages, and menus. That reduces whiplash, even if individual prices still move for their own reasons. Flip the view. Hold $1 constant and watch how much sandwich it buys across decades. Over time, that slice shrinks when the overall price level rises, even if the sandwich doesn't change. Your memory picks a base year. Starting from 1980 feels different than starting from 2000. Different bases change the mood, but the mechanism is the same. Purchasing power moved. The tricky part is pace. Small yearly erosion is easy to miss until it adds up. That's why ordinary prices can surprise you years later, even without a fancy new recipe. Keep one clear test in mind at the counter. Did the thing change or did the yardstick? With inflation, the lens often points to the yardstick. That's why a plain sandwich keeps feeling pricier. What if the variable isn't the sandwich at all, but the value of the money? When a unit shrinks, tags read higher, even if the thing itself barely changes. If many everyday prices climb together, that points to the currency, not a sudden recipe revolution. Broad moves signal purchasing power shifting, not dozens of secret upgrades to ordinary stuff. Here's the flip. It's less that sandwiches got expensive than that dollars got cheaper. Inflation is the quiet shrinking of the measuring unit, translated into bigger-looking tags. Even with raises, purchasing power slips when price growth outruns pay growth over a year. That mismatch explains why lunch can sting despite a higher number on the paycheck. When pay grows faster than inflation, real earnings rise and the squeeze eases. Category mix still matters. Groceries versus cafes. So experiences can differ even as trends improve. The memorable takeaway: Prices look higher because the dollar's buying power got smaller. This is education, not financial advice. Think in purchasing power, not just price tags. Takeaway to keep: same sandwich, smaller purchasing power behind each bill. Education, not financial advice.